makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Francine Lacqua is in Singapore at the New Economy Forum. Let's start with what's coming up on today's program. European banks beating across the board, with Commerce Bank and Credit Agricole both rallying. ABN AMRO, on the other hand, one of the biggest fallers on the European stock 600. Meanwhile, tire maker Continental cuts its revenue outlook for the year on currency effects while making headway on those improving returns. More from our interview with the CFO shortly. Plus, we're live at the Bloomberg New Economy Forum in Singapore. Guests this hour, including Scott Goodwin of Diameter Capital Partners, as well as Elizabeth Rossiello of AZA Finance. I want to get started by looking at the markets here because, of course, European markets are going to be mixed. A slew of earnings that you are going to see across the board. You are seeing some broad green on the screen when you look at, say, the FTSE 100, for example, but really broad weakness when you look at the DAX and the CAC 40 as well. A lot of that is going to come from the earnings story specifically. Remember, we did get, not only did we get Bayer and Adidas and Munich Re this morning, all of which, by the way, didn't have the best earnings stories to tell. So, again, that's going to be weighing on the DAX and the broader industrial complex in Europe as well. So that's going to be something we're going to keep an eye on. But right now, the story you need to know, so whereas the broader continent is in the red, you are seeing some outperformance in the green right here in the UK and in Ireland as well. That is your market story. I want to toss it over to Francine Lacqua. She is standing by in Singapore at Bloomberg's New Economy Forum. Francine?
Thank you so much, Kriti. So let's maybe start off with stocks in Europe. Now, here in Singapore, we've definitely been focusing on geopolitics, some of the concerns, and what it means for cooperation amongst countries. Now, what investors want to know more is Fed officials due to speak later this week. We also heard from John Waldron of Goldman Sachs, and he was saying the still biggest concern is inflation. Then the Minneapolis Fed President Neil Kashkari, who was on Bloomberg surveillance yesterday, saying policymakers have yet to win the fight against inflation. They will consider more tightening if needed.
There's no discussion amongst me and any of my colleagues about when we're going to start preparing to cut rates. The only thing that's been talked about at all is that at some point, when inflation is well on its way back down, if we didn't back off a little bit, then real rates would be getting tighter and tighter and tighter.
From inflation, we talk credit. Joining us now is Scott Goodwin. He's managing partner and co-founder of Diameter Capital Partners. Scott, great to speak to you. You're like the credit guy, right? The rising star in trying to figure out opportunities and concerns in the credit market. Where do you see opportunities?
Thanks for having us, Francine, or thanks for having me today. I think from an opportunity set perspective, dispersion's rising across credit markets. That's exciting. Volatility, whether it's geopolitical or U.S. inflation-based, is creating opportunities in different subsets of asset class. At the index level, investment grade, high yield, they look very uninteresting. But beneath the surface, there are things changing. Specifically in leveraged finance, we're finding opportunities. We talked a lot today about the decarbonization at this conference. The cost of capital for some of those solar projects in the U.S. has gone up. So whether it's lending to the solar residuals at 20% for 750 FICO consumers, or LNG first lien debt at 10%, there are real opportunities that we're starting to find in that decarbonization space as the cost of capital is rising. I do think that other parts of the credit market, driven by what happened post-SVB with the U.S. banks, are becoming more interesting. They're less liquid, but regulatory capital trades, you're seeing the U.S. banks and global banks under much more regulatory pressure, and they're looking to divest assets or put on hedges. So we've seen them come to us and others for hedges on their corporate revolver books. Investment grade revolvers, we're getting low teens for a 0 to 10 tranche, and for LevFin, high teens for 0 to 15. So that's really interesting mispriced risk in our view.
But Scott, when you look at industry, so you mentioned renewables, is there any other industry where you see opportunities at the moment?
Sure.
As frankly, I mean, inflation, interest rates probably create opportunities, but also a lot of risk.
Absolutely. I mean, telecom and healthcare, my whole career, that's what we bought when the market went down. Now they're the two industries in stress and distress for different reasons. We found a lot of opportunities in the telecom enterprise fiber space this year. We still think there's interesting opportunities there. Healthcare, we've been more mixed on. I think the policy volatility related to some of the LBOs there are leading to different outcomes than the market expected. So telecom's been an easier bet for us, and we'll stick with that.
And this is what, worldwide?
Well, more U.S., frankly. Okay. Europe has a telecom opportunity as well, but it's the national champions tend to trade much tighter than they maybe should based on credit metrics. So the U.S. opportunity set is a little deeper in the enterprise fiber space.
So Scott, when you look at fixed income like government bonds, I mean, what's the correlation between some of the corporates that you're looking at and actually what treasuries are doing?
It's actually been really almost too high this year. You've had a huge policy tightening and spreads have remained reasonably benign and really correlated to rates. What that's meant, though, is dollar prices on debt. So if you bought a bond at par or 100 cents in 2020, let's say an Apple or Amazon long bond with a 2% coupon, that bond just on duration is now in the 50s or 60s. So you have a really different conversation where spreads aren't that interesting, but your enterprise value create and your current yield on a leveraged finance or investment grade bond might be interesting. So for liability-driven investors, they can really defease part of their liability structure, especially in the long part of IG. 6-7% yields on long duration investment grade debt. That's really interesting.
Anything distressed?
Distressed, I mean, I think it's a little early. We see it coming from the levered loan market. That's where a lot of the bubble has built up along with private credit over the past few years. Those markets have doubled in size. High yield's effectively unchanged the past 6 years. So high yield is become a higher quality product with bigger companies, whereas levered loans and private credit are smaller companies, more levered, lower quality, and we see those cycles starting to build. A lot of the creditor on creditor violence you read about or write about on TV is where we'll start to see opportunities. Sectorally, again, it's telecom, it's healthcare, it's parts of the industrial food chain. One thing that I wouldn't necessarily call distressed, but comes out of some of the things we talked today about climate change, U.S. cat insurance or reinsurance opportunity this year, policy rates have doubled. So you've had a real opportunity, uncorrelated opportunity this year to put capital into there. And we hadn't done that since Sandy and Katrina. So it's not distressed, but it's certainly dislocated and uncorrelated. That's been really interesting as well.
And are you expecting more dislocation in the next 6 to 7 months? Again, it feels like we're in a juncture in terms of the cost of money, the cost of credit, and actually what rates do.
Yeah, the U.S. economy's slowing slowly. You don't have layoffs yet. I think that's what we would look for the U.S. consumer to start to have a little bit more of a struggle to get more negative on the market. But Europe's in a recession now, so there certainly are some opportunities there. And I think you'll see as political volatility and interest rate volatility combined, that will create a lot of opportunities on a forward-looking basis.
But do you think, and we started seeing it in some of the numbers for even credit consumption or actually paying back credit cards, do you see it going to actually companies defaulting?
Not in the near term. It takes time to default, and the creditor-on-creditor violence that we're seeing in the levered loan market's actually creating a longer runway for many of these companies. They're moving assets away from creditors to create more runway. You're actually seeing the same thing in European REITs. The European REITs were all funded by the ECB at 1% for 5 years with the CSPP program. Now those bonds are trading in the 40s and 50s. They have 1, 2, and 3 year maturities. We like those front-end bonds because what the REITs are doing is they're selling assets, they're moving assets away, and in some cases we're providing that capital to help them extend their runway. But that disfavors the long duration debt and turns that effectively into a long-term zombie.
Where does capital go into 2024?
The front end of the IG curve and the front end of the T-bill curve is where it's been going. You can statistically see that. I think there's a case to be moving into the intermediate part of the investment grade curve. Lev fin at an index level, not interesting. At a yield level, in parts of high yield, I think you can make the case for double Bs, 8-9%, low dollar price. You're probably not going to lose money making those investments.
Scott, it's amazing when you look at the growth of diameter, right? Exponentially over the last couple of years. How do you compete with the big firms?
So I don't view it as a zero-sum game. Apollo buying a stake in us last year, a sub 5% stake, was part of
big deal.
Yeah, big deal, but part of staying independent. We've been approached in the past. John and I want to run the business ourselves, and our view is partner with the smartest, most nimble, largest big guy, and that helps us from a resource perspective, but it also helps us run our business the way we want. We choose alpha over beta in sizing our products, and that's something that we plan on continuing to do. I also think that when you think about the syndicated market, our scale, where it is now, we're just as relevant as many of those large players. Not in the private markets, and we'll get there eventually. Apollo's seeding our private debt business as part of that deal, and which we're starting to raise the capital around them now. But it's an exciting time in syndicated markets, and I think the private market opportunity is about to really ramp up because you start to see when the economy weakens, more non-sponsor deals, and that's where we really want to focus over the next 12 to 18 months.
And so the biggest hurdles actually in those next 12 to 18 months to be sure that you grow in those businesses is what, just raising capital?
Capital formation, yeah.
And that comes from where?
Everywhere. I mean,
but there's not a part of the world, or you're not trying to tap into.
I've got a lot of neighbors who are flying to the Middle East every week. I usually sit at my Bloomberg terminal and work. Eric got me out here this week, but we're really focused on running our business, and the capital will come if we put up returns.
Scott, thank you so much for joining us. Scott Goodwin, their managing partner and co-founder of Diameter Capital Partners. Now, we'll have plenty more, of course, from Singapore. Also, we focus on the Middle East. Israel says its troops have entered the center of Gaza's main city. Meanwhile, Saudi Arabia says normalization talks with Israel remain on the table. So more from the Middle East up next. This is Bloomberg.
The conflict in the Middle East is troubling, and we're obviously praying for a peaceful resolution and for the well-being of the innocent people who are suffering there. But beyond this tragic phase that we're going through, investors domestically and internationally are trying to address long-term issues and realize opportunities that are quite prevalent today and available today in the Kingdom of Saudi Arabia.
Well, that was the Saudi Investment Minister, Khalid Al Fallah, speaking, of course, on the sidelines of the Bloomberg New Economy Forum here in Singapore. Now, that comes as Israel says its troops are now in the center of Gaza's biggest city. Let's get some analysis with Bloomberg's EMEA News Director, Ross Matheson. Ross, good to see you. So what's the latest from the region?
Well, as you were saying, we know that Israeli troops have been encircling Gaza City for days, and they're now conducting full-scale operations inside the city, pushing further into the center of what is a very highly densely populated area of North Gaza. They say, of course, that this area, this city, is really the stronghold for Hamas's forces, militant groups in the north of Gaza. But there are a lot of civilians there, obviously, also. So what we're seeing now is it move into a real ground war stage, street to street, potentially door-to-door fighting that's going to go on. Israel says that they'll be focusing on what they say are the strongholds of Hamas inside the city, but those are quite contentious also because Israel accuses Hamas of using some of the hospitals in the region, for example, as places to stage attacks on Israel, but there are a lot of civilians at those hospitals at the same time. So it's entering a much more delicate phase of the conflict on the ground, a much more careful phase, you would imagine, in terms of this conflict. But we are going to see door-to-door combat potentially as a result.
So, Ross, the Saudi investment minister also says normalization talks with Israel are still on the table. How significant is this?
Well, it's interesting to see those comments because, of course, since the war broke out, Saudi Arabia has been sort of strongly concerned about the situation inside Gaza and the Palestinian question more broadly, and warning Israel on that front. And in that environment, no talks can happen at all. There was sort of months of work towards a careful move towards normalization of ties between Israel and Saudi Arabia. Nothing can happen in this environment. And Israel says this conflict could go on for weeks, months, or potentially longer. So for now, nothing at all. But at least the comments from the Saudi minister were indicating a desire to have some kind of communication channel still open on that front. And longer term, depending on the trajectory of this conflict, and particularly the resolution of the Palestinian question, the door is still open at least to some sort of normalization trajectory. But right now, there's no progress that's going to happen on that front.
Ross, thank you so much. Ross Matheson there. And of course, we'll continue watching developments on the ground. Coming up, we also take a look at European banks in the earnings seasons with both Crédit Agricole's and Commerzbank up after earnings speed. That's next. And this is Bloomberg.
What we have really improved, and our outlook is that we said that our tires margin will be improved. So we've increased the outlook from 12 to 13%, up to 12.5 to 13.5%. What we will see during the course of the fourth quarter is a further improvement on the automotive side to come to our to the guidance that we've laid out for this year, and that will come to a major extent also from increased automotive R&D reimbursements that we traditionally do have in the fourth quarter of the year. That will help us to drive performance in addition to the cost discipline that we still have to show, and further operational improvements coming, amongst others, from more stable supply chains.
Costs in focus everywhere. More on that, no doubt, in a moment. Can I ask you about the EV business compared to the legacy internal combustion engine or ICE business, Katja? How profitable can your EV business be compared to the legacy technology?
I think what you need to understand, and when you look at our current product portfolio, is that we do not depend on the powertrain that much. With the spin-off of Vitesco Technologies, we got rid of the majority of our powertrain-dependent business. You will need brakes in all cars, no matter if it's an ICE or a new electric vehicle business. You will need 4 tires on those cars. There will be some changes in the mix components, but overall, to us, it's not of that high relevance anymore what kind of cars are being built. Which means
Katja,
also when you look at the development of our profitability,
though? Yeah, don't you have to replace them less frequently? The brakes, for example, on EVs.
I don't think that this is so far to be really talked about right now. What we're currently looking at, if there are some more changes necessary, for example, on the tire side, but there you also do have different input factors. You do have more traction on the vehicles. The vehicles are more heavy. On the other side, the driver drives a little different when you look especially on the long distance things. So now that we see the things coming into place, we will need to see how the replacement businesses will really happen. It's still a matter to be finally evaluated.
That was the Continental Chief Financial Officer speaking earlier this morning to Anna Edwards. Now, we also had a number of earnings. Commerzbank and Crédit Agricole shares both higher this morning. Now, the German lender lifted its earnings goals and also announced a buyback. France's Crédit Agricole beat on revenue and net income after fixed income trading revenue jumped some 26%. Now, the Chief Financial Officer shared his economic outlook for Europe after the earnings beat.
In terms of economic outlook, what we see going forward in France and in the Eurozone, it's a slowdown. It's not a recession. So we are very cautious, of course, on the future data that is going to give more precision on the evolution of the economy. But seen from now on, what we see is a slowdown, not a recession.
And speaking to us earlier, Commerzbank's CFO also discussed the impact that rates are having on net interest income.
Pass-through rates will go up, will further increase. So that will have a negative impact on the NII. And then we clearly also have our replication portfolio, so the moderate deposits. And there we expect benefits, but this benefits will really play a more important role from 25 onwards.
Bloomberg's Tom Metcalf joins us now. So, Tom, what were your takeaways from Crédit Agricole and Commerzbank?
Well, yeah, pretty positive signs. At least you should look at their share prices; they're all up. For me, I'd also bring in ABN AMRO just to show what a sort of a muddy picture it is in banking at the moment, because their shares have absolutely fallen, pretty much for the reasons the Commerzbank CFO was just outlining, is that net interest income. So for me, it's just how by market, as you go across Europe, you can have one bank shareholders still rewarding them for this interest rate boost, whereas when you move to say Holland, their ABN AMRO are getting absolutely hammered.
So, Tom, how has the wider European banks picture looked this earnings season?
Yeah, I think it's just this really mixed picture. So we're trying to think of what is the one through line for banks, and right now it's a pretty complicated picture. Every bank has almost its own story to tell. So yesterday we obviously had UBS has got a very big, very difficult integration that really drives all the shares at the moment on that side. And then you look at what the Crédit Agricole executive was just saying, how strong they were in trading income, and also relatively positive on the macro outlook. So yeah, just as you bounce from bank to bank, I'm afraid there's no one clear picture. The only thing I would say, being based in London, the UK banks are much further along in this cycle, and it's been pretty grim for them this earnings season.
All right, Tom, thank you so much. And of course, just minutes ago, UBS also beginning the sale of the first AT1 bond since Credit Suisse's collapse. So we'll have plenty more on that throughout the hour. Now, coming up, we'll bring you our exclusive interview with Khalid Al-Fallah, the Saudi Minister of Investment. He discussed the Israel-Hamas conflict at the margin, as well as the global economic outlook. That's coming up shortly. And this is Bloomberg. European banks beating across the board, with Commerzbank and Crédit Agricole both rallying. ABN AMRO, one of the biggest followers on the Euro Stoxx 600. Tire maker Continental cuts its revenue outlook for the year on currency effects while making headway on improving returns. Now, more from our interview with the Chief Financial Officer. Plus, we're live here at the Bloomberg New Economy Forum in Singapore. Coming up, Elizabeth Rossiello of AZA Finance. Well, good morning, good afternoon, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Singapore. Now, geopolitics dominating the opening of the 6th annual Bloomberg New Economy Forum in Singapore. Now, days ahead of an expected meeting between President of the U.S., Joe Biden, and Chinese leader Xi Jinping, the Chinese Vice President Han Zheng has called for greater global cooperation.
China commits to advancing high-level opening up and steadily expanding institutional opening up of rules, regulations, management, and standards. We will provide more market and investment opportunities for companies from all over the world to share the dividends of China's institutional opening up. Unilateralism and protectionism lead nowhere. The issue of security cannot be overstretched. Decoupling, severing industry and supply chains, and the so-called de-risking will all only divide the global economy into many isolated islands.
On U.S.-China relations, we also heard from the Chief Investment Officer of Templeton Global Investments.
No, I think in the very short term in China, we could have a catalyst with the upcoming meeting potentially between President Biden and President Xi. With a bit of luck, that happens in San Francisco next week. And if that happens in the near term, in a positive vein, that could provide a temporary floor in China equities, improve sentiment.
And Middle East tensions, also, of course, a major theme here at the New Economy Forum. Saudi Arabia's Minister of Investment says talk towards normalization of ties with Israel remain on the table. But he says they have always been contingent on a pathway to a peaceful resolution of the Palestinian question. Now, we spoke to Khalid Al-Fallah earlier.
You know, the conflict in the Middle East is troubling, and we're obviously praying for a peaceful resolution and for the well-being of the innocent people who are suffering there. But beyond this tragic phase that we're going through, investors domestically and internationally are trying to address long-term issues and realize opportunities that are quite prevalent today and available today in the Kingdom of Saudi Arabia to address these long-term issues. So as you look at energy transition, Saudi Arabia has the formula for it. As you look at global supply chain challenges and the need for resilience, regionalization, being close to markets, having the right logistical and infrastructure capabilities, whether it's physical or digital, Saudi Arabia has the solution for it. If you're looking at capital markets with many countries going through exchange rate, interest rates, and the lowest cost of capital, and then Saudi Arabia has the right formula for it. If you're looking for investors to invest with, the Saudi domestic investors are capable. So we tick all of the boxes, and I think beyond the current situation in Europe and the Middle East, tension here in some parts of Asia, people will look around and find Saudi Arabia as the best destination to invest. It's happening now, and we believe that we will transition through the crisis, the set of crises going on now, and Saudi Arabia will continue to be a very attractive destination for investments.
Minister, do you worry that there will be a pause, actually, in money coming into the region?
I don't worry about that. I think investors have seen that through multiple crises over the previous 60 years or so, that Saudi Arabia has continued to be a friendly jurisdiction for international investors, a stable jurisdiction with a very stable economic and political system that they can rely on.
Minister, talk to me a little bit about the fact that actually you're changing the accounting to look at FDI. What does that mean in terms of figures that you'll look at?
Well, we've been relying on our central bank to estimate what FDI numbers are, and they've been doing that for quite a few years, a couple of decades. Just recently, when the Ministry of Investment was created, we worked with colleagues across the Saudi government, our statistical authority, as well as the central bank, and we transitioned to the gold standard system of accounting per the IMF methodology, which is to actually measure to the last dollar from the financial statements of all registered international investors in the kingdom.
Does it help with the numbers?
In terms of FDI flows, the numbers are very, very healthy. They have positioned the kingdom. If you look at 22 and 21 data, we're actually number 10 globally. The Saudi economy today is number 17 globally, but if you, in terms of FDI, both as a percentage of GDP and absolute numbers, we're last year we attracted about $33 billion of inflows. And the year before that was also a very healthy number.
Khalid Al-Fallah there, Saudi Arabia's Minister of Investments. Now, these are some of the other things that we're following today. And Portugal's Prime Minister António Costa has unexpectedly quit after revelations about possible government corruption involving lithium and hydrogen projects. Now, Costa's departure marks the end of an 8-year tenure and will likely lead to an early election. At a press conference in Lisbon, the former PM said he has a clear conscience. His clear conscience will cooperate with the investigation. Uber gave a mixed picture of its business, reporting its second consecutive profitable quarter, but also slowing revenue growth. Now, overall trips were up 25%, boosted by its rideshare unit. However, total revenue grew at the slowest pace in 10 quarters.
Well, the revenue growth slowdown is, again, purely as a result of these accounting reclassifications. If you look at the business and the bookings growth, which is really consumer demand, both on the ride side and on the delivery side, both of them accelerated. So our mobility business grew gross bookings 30% on a year-on-year basis. It was an acceleration over Q2.
Well, sources say Apple has paused work on next year's software updates for its devices, including the iPhone and Mac, to deal with glitches in the code. Now, we're told engineers are fixing a range of bugs found in earlier versions rather than adding new features. Ping An Insurance shares fell today, despite the company denying a report that Chinese authorities have asked it to take a controlling stake in troubled developer Country Garden. Now, according to Reuters, China's State Council has instructed the local government of southern Guangdong province to help arrange a rescue. Ping An said in a statement the report is completely untrue. Earlier, Benjamin Deng, the Ping An chief investment officer, shared his outlook for risk assets.
We've locked in higher interest rates in the past years and building up our portfolio so we can ride through the lower rate periods. And then in these periods, we should see risk assets like equities, real estate, and the private equities going up.
Well, that was Benjamin Deng there, Ping Yang's Group Chief Investment Officer. Coming up, we talk to AZA Finance Chief Executive Officer and Founder Elizabeth Rossiello on the challenges of expanding in frontier currency markets. This is Bloomberg. The conversations that matter, the insights you need. Welcome back. This is The Pulse. I'm Francine Lacqua here in Singapore. Now, joining us now, Elizabeth Rossiello, Chief Executive Officer of AZA Finance, a Kenya-based fintech startup providing currency trading solutions to frontier markets. Elizabeth, thank you so much for joining us. I mean, there's been a lot going on. We're just talking about it in the crypto world in the last 12 months. When you look at some of the money-changing hands in this world and what AZA is actually facilitating, what's the value of it right now?
Well, what we see right now is that growth stage businesses, specifically fintech businesses that stayed the course through the fintech winter of the last year, are still trading and volumes growing. In fact, we recently said that no customer is too big for us. We're starting to see Fortune 50 companies, global corporates decide that working with a fintech is not a strange thing anymore. It's the best and most efficient way. Some of our competitors and some of our traditional incumbents are now partnering with us.
Has it been like, has been the trend just growing, or has it been pretty volatile, pretty choppy?
Well, I think a lot of the younger competition just exited the market, to be honest, or those who got Series A funding when money was loose and free weren't able to follow on. So those that remain are winner takes all mentality.
Talk to me a little bit about fundraising. Are you fundraising at the moment?
Who's never fundraising? But I mean, what we've seen is about $1.5 billion in fintech funding in the last couple of years in Africa. And there's, of course, 1.5 billion people on the African continent, so $1 for every person. But we can have a lot more to go.
What's your outlook for, in general, digital currency in Africa?
I mean, honestly, 10 years later, we still seem about the same proportion of people trading. It's not so much on a retail daily use. People aren't buying milk or paying rent in crypto, but we are seeing businesses use it to settle payments, specifically between Africa and China, which is quite interesting. A lot of factories are now taking digital currencies, mainly stable coins, so dollar derivatives, G8 currency derivatives. I think, you know, the other kinds of coins just never gain popularity on a huge scale level. You still see the same, you know, level of adoption that you saw a couple of years ago.
But has any of the big sagas that we've all followed very closely actually changed or delayed some of the adoptions that you were expecting?
Well, I think, of course, the regulators were just, like everywhere globally, fed up with that kind of nonsense. And so I think when you saw the collapse of some of the big crypto players, regulators woke up. Same thing a couple years ago with the first crypto bust, you know. We've now survived, we're 10 years old as a company. We've survived 3 crypto winters at this point, and the regulators always come in strong afterwards. But that's why we're a hybrid business, and over 80% of our volume is fiat.
What do you become, actually, in 3-4 years?
We think we're going to become the largest non-bank broker on the continent. I mean, we're already doing about $300 million a month in volume, which is small for a bank, but gigantic for an African fintech. And we're seeing now Tier 1 and Tier 2 banks trade with us directly. So again, you know, first we saw other fintechs come to us, then corporates. Now we see financial institutions trade with us.
Elizabeth, do you think you're a takeover target? Would you like to be a takeover target?
I mean, we've had some offers. I'm a pretty picky person. I think for us, we spent 10 years building, and we know that the market is unique. We've seen a lot of South American interest, to be honest, which was a surprise. A couple of years ago, we had a lot of Asian interest come into the continent, but there's a lot of similarities between South American companies and African companies, given the diversity of the national markets, the regulatory, you know, development, et cetera. I think what we really need to see is who can understand emerging markets best.
Right. But so interest from South America because they like the technology and then replicate it also where they are?
Yeah, I think, you know, when you have a large continent with 55 markets, it's not the same as an American market. where you can have one product with one gigantic market, or Korea, where it's a very high population density. When you have to go across the region, it takes a different kind of operational model. And we see Southeast Asian and South American companies kind of fit best with a roll-up strategy on the African continent.
Elizabeth, I mean, one of the questions we had is, were some of the operations actually limited by, limited supply of dollar, but also some of the volatility that we've seen in emerging currencies?
I mean, people always ask me this, what about the volatility, right? But I mean, fortunes have been made all over the world trading volatile financial assets in Zurich and Hong Kong and London, right? We know how to trade volatile assets. Back when I left school, everybody was trading, credit financial assets that were volatile. You can make money and be risk avert and risk careful in these markets if you just apply the same risk strategies everywhere else. I think we go into it knowing that our markets are volatile, so our business model works for that. We make sure that at the end of the day, we have eliminated risk, we've de-risked ourselves, our balance sheet is healthy. I think that's the most important thing. But that just tells you not every fintech is fit for these markets.
So it's basically like almost, you're fit for purpose, right? If you're built and you get the volatility, then your operations are not impacted.
Yeah, I always say we're born for volatility. So when COVID happened, we thrived. So did a lot of other African companies that were used to dealing with work from home staff during election violence or like a flood or a power outage. We had policies already for that. So, it's very easy for us. We're also a tech company, so our engineering team was always remote. So, these sorts of things make us more resilient. And I think when you start your market in Kenya and your third market is Nigeria, currency volatility is not something that you worry about. What you really worry about is the traditional things, partnering with the incumbent banks. I think that's the harder aspect to control.
And that's coming, or is it?
Well, it still happened after Silvergate and Silicon Valley Bank went out of business. I think it became very hard for fintechs globally, not just in emerging markets, to become banked. And I think that's still a major issue. It's almost like we went back to the drawing board.
Right.
And now we're seeing more regional banks, regional champions that weren't so technology focused or startup focused kind of come online. And if you're in the geography and they understand you, they're partnering, as opposed to having a global technology specialist that doesn't understand the regional differences.
But is that partly also regulation?
Partly regulation, partly management, partly time to understand local business models. I don't think just because you're a technology company, that means you have a certain business model. So how can a bank bank every technology company, right? Yeah. I think we need to have more specialist credit teams and more banking teams understand the startups in their region and in their sector.
Elizabeth, thank you so much for joining us.
Thanks for having me.
That was the Chief Executive Officer there of AZA Finance, Elizabeth Rossiello. Now, we'll have plenty more, of course, from Singapore here at the New Economy Forum. We also heard BOE Governor Andrew Bailey speaking at the Financial System Conference 2023 in Dublin. Now, he's speaking actually at the moment live. He's talking about Brexit having reduced the openness of the UK economy. Governor Andrew Bailey also talked about fragmentation being a risk to financial stability. We'll have plenty more. We'll listen in actually to what the governor has to say, and we'll have plenty more on some of those headlines. Coming up, geopolitics dominating so far this year's Bloomberg New Economy Forum. We wrap up today's themes and conversations next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in Singapore. So geopolitics has dominated the opening of the 6th annual Bloomberg New Economy Forum here in Singapore. Earlier today, China's vice president called for greater global cooperation. Those comments days ahead of an expected meeting between U.S. President Joe Biden and China's Xi Jinping. Now, joining us now is Jennifer Welsh, Chief Geoeconomics Analyst at Bloomberg Economics. Also freshly started at Bloomberg, you come from the White House, where you're Special Advisor to the VP on all things Asia and China. So, Jennifer, first of all, welcome to Bloomberg. Welcome also to The Pulse. I mean, there's a lot going on, and it's very clear that geopolitics kind of undermining all of the efforts maybe for global cooperation. What do you most worry about right now?
I think there's a couple of dark clouds already over us and a couple of dark clouds on the horizon. A lot of the conversation today has focused on the ongoing war in Ukraine, the new war in the Middle East, and then looming on the horizon, intensified U.S.-China tensions, and in particular around Taiwan, which is going to be holding its election in January. That's always been a sensitive issue in U.S.-China relations. It's coming at a moment where the U.S. is also preparing to hold an election, and China is already very much on the campaign trail. And I think all those dynamics combined presents a concerning picture for business leaders and for investors and governments trying to navigate these dynamics.
What does China want? I mean, there's also talks about them trying to build a base in the Middle East. Like, how difficult is it for us to understand what their end game actually is?
China's endgame in the Middle East, I think, is an evolving picture. We've seen Beijing try and play more of a role as a global peacemaker, and in particular in the Middle East, earlier this year brokering a deal between Iran and Saudi Arabia to normalize ties. Now, with the ongoing war, we've seen Beijing try and play more of a diplomatic role in the region, while at the same time still trying to understand the really complicated dynamics there. This is a really controversial area to step into, and I think Beijing is trying to be careful in maintaining its ties to the global south, which is really important about Palestine, while also maintaining its relations with Israel at the same time.
I mean, how is it looking at Taiwan? Again, we're also in the U.S. election year next year, so everything can change if we were have to have, President Trump 2.0.
That's exactly right. And I think these two elections combined is going to make for a very dramatic year for those of us watching geopolitics. In terms of Taiwan, Beijing is definitely watching the election really closely. It's a crowded candidate field, but one of the candidates is someone that they regard with a lot of suspicion. Several of the others are kind of more wild cards, or in some cases, people that they know pretty well. And they all are presenting very different visions for Taiwan's relationship with Beijing. So whoever wins from that, and however Beijing and Washington respond to that election, could have major implications for that relationship.
But because we're in an election cycle, are we just going to have much more China bashing? And I've always been told, I don't know whether it was erroneously, that you have to make sure that the Chinese feel understood. It's not by putting tariffs that they feel understood.
I think there is a huge potential. I mean, we're already seeing it for China to be a major focus of conversations within the U.S. domestic policy circles, and in particular in the lead up to the election. Already it's becoming an issue on the campaign trail, and the incentive is for candidates to be as hawkish as possible. So I think that definitely introduces the potential for more friction in the relationship between now and next November, and certainly the possibility, as you noted, for a change in approaches depending on how that election goes.
Jennifer, great to have you on the program. Thank you so much for
you.
joining us today. That was Jennifer Welsh from Bloomberg Economics. Now, we're just over day one here at the Bloomberg New Economy Forum. We have lots more to come tomorrow. Don't miss our exclusive conversation with the UBS Chief Executive Sergio Armotti. That's tomorrow, Thursday at 9 a.m. London time. We also have Citadel's Ken Griffith, and here joining will be also Hillary Clinton. It'll be interesting to get her thoughts on the Middle East, Israel, and Gaza. Up next, a Bloomberg Brief, Danny Berger in London, Manus Cranny in New York, and this is Bloomberg.